In 2026, choosing between a fixed or a variable mortgage might be one of the hardest decisions we've seen in years. Because for the first time in a long time, the data is split, experts are split, and even homeowners are split. Variable rates are lower, fixed rates feel safer, and the future is uncertain. So in this video, I'm going to break this down in a way that helps you avoid making a decision that you'll regret later. Let's start with the big picture. We're no longer in a falling rate environment. The Bank of Canada has already cut rates down significantly from the peak, and now we're sitting around the bottom of the neutral range. Most major banks are forecasting rates staying relatively stable through 2026, with some risk of slight increases into late 2026 or 2027. So what does that mean? We're in a transition market. And that's what's important, because now you're not just reacting to rates, you're trying to predict what happens next. Now, one thing I want to quickly touch on, because this is where a lot of people get confused, is what actually drives mortgage rates. Because it's not just the Bank of Canada. Rates are influenced by a few key things. First is inflation. If inflation goes up, rates tend to stay higher or even increase. Second is the bond market. Fixed mortgage rates are actually based on government bond yields, which move daily based on what investors expect. Third is global events. Things like wars, trade tensions, or oil prices can push inflation higher and create uncertainty. For example, conflicts in the Middle East have already started putting upward pressure on fixed rates. And fourth, the overall economy, things like job growth and spending. So when you hear people say rates are going down or rates are going up, it's not that simple. There are a lot of moving pieces behind the scenes, and that's exactly why this decision is so difficult right now. Let's simplify where things stand today. At the time of this video recording, fixed rates are roughly around the mid 4% range, while variable rates are slightly lower, around the low 4% range. So on a $500,000 mortgage, that's about $100 per month difference. So naturally, people are thinking, why wouldn't I just take the cheaper option? And this is where most people make their first mistake. Most people choose their mortgage based only on today's interest rate. But that's not how mortgages work. Because your decision isn't about today, it's about what happens over the next 2, 3, 5 years. So instead, we need to look at scenarios. If rates stay flat, variable typically wins. In a 5-year term, if you choose variable today, you can save around $35,000 in interest. If variable goes slightly up, around 0.5%, fixed and variable are roughly equal. So you're not really ahead either way. But if variable rises more significantly, around 1%, fixed starts to win. So variable payments increase, and you could be paying hundreds more per month. So the real question becomes, what do you think is more likely? But even more important, what can you actually handle? Because here's the truth that most people don't talk about. There is risk no matter what you choose. With a variable rate, your payments can increase. You could experience a payment shock. And in some cases, your amortization can extend, and you're relying on the market to cooperate. There's also a psychological side to this. A lot of people got burned in 2022 and 2023 when rates rose quickly, and that fear is still very real today. On the fixed side, you could lock in at a higher rate than necessary. If rates drop or stay flat, you may overpay. Also, breaking your mortgage early can be very expensive, sometimes costing tens of thousands of dollars due to something called an interest rate differential penalty. And you lose flexibility if your plans change. So you're not choosing between good and bad. You're choosing between different types of risk. This is also why this decision feels so difficult, because mortgages aren't just numbers, they're emotional. Ask yourself, would a $300 to $500 increase in payment stress you out? Do you check interest rates every time the Bank of Canada makes an announcement? Are you okay with uncertainty, or do you prefer stability? Even relationships can be affected. If one partner is comfortable with risk and the other isn't, that can create tension. So this decision isn't just financial, it's personal. Now let's talk about something that's often misunderstood. Not all variable mortgages work the same way. There are adjustable variable mortgages where your payments go up or down as the rates change. These are more transparent because you feel the impact right away. Then there are fixed payment variable mortgages where your payment stays the same at first, but then the portion going towards interest increases as the rates rise and vice versa. Now this is where something called the trigger rate comes in. The trigger rate is the point where your entire payment is only covering interest and you're no longer paying down the principal. If rates go beyond that point, you can actually start going backwards. That's what's called negative amortization, where your payments aren't covering all the interest and your mortgage balance can actually start to grow instead of shrink, because that unpaid interest portion gets added to your principal. Another thing people often say is, I'll just switch to fixed later if needed. Yes, you can do that, but the fixed rate at that time could be higher, and the timing in the market is extremely difficult. So that should never be your main strategy. This is how professionals actually evaluate mortgages. Not just by the rate, but what is called the 4 Ps. First is prepayment. Can you pay extra towards your mortgage? Second is penalty. What happens if you break it early? Fixed mortgages can have very high penalties, while variable mortgages are typically limited to about 3 months interest. Third is portability. Can you take your mortgage with you if you move? And fourth is price. Yes, the rate matters, but only if everything else fits your situation. Now here's something that's becoming more popular in 2026. Short-term fixed rates. One that has been particularly popular is a 3-year fixed term. This gives you stability in the short term, flexibility to reassess later, and less commitment in an uncertain market. Okay, so let's make this practical. A fixed rate might be better for you if you want stability, you have a tighter budget, you don't want surprises, and you plan to stay long term. A variable rate might be better if you have a financial buffer, you're comfortable with fluctuations, you value flexibility, and you may refinance or move earlier. A short-term fix might make the most sense if you're unsure, expecting changes in your life, or want to wait and see what happens with the rates. Here's where people tend to get this wrong. Choosing based only on the rate, ignoring penalties, not understanding how variable mortgages actually work, trying to time the market perfectly, overestimating the risk tolerance, or locking into the wrong term length. Now here's something interesting. Historically, variable rates have actually come out ahead about 80% over long periods. But that doesn't mean it's always the right choice, because what's mathematically better is not always emotionally better. So what's the right answer? There isn't one. I've personally experienced both options. Fixed gives you protection, variable gives you opportunity, short-term gives you flexibility. The best mortgage is the one that you can live with and the one that your lifestyle can sustain. In 2026, the smartest buyers aren't chasing the lowest rates. They're choosing the strategy that fits their life, their risk tolerance, their future plans. And if you're still unsure, that's completely normal. This is one of the biggest financial decisions that you'll make. And getting it right starts with understanding yourself just as much as understanding the market. If you're new to my channel, I'm Evangeline, mortgage broker and partner at Alltrust Mortgage Solutions here in Greater Vancouver. And if you learned some new things from this video, please hit the like and subscribe button to help it reach more people. I'd love to continue the conversation, so drop your comments or questions below.